let's turn it over to you. I think we've been on top of most of the questions here. There's a question about MSTR. You could talk about the vols there because that's really the Bitcoin name. I would love to
Yeah.
see that. And then if you want to talk about the
Do you want me
VIX.
to yeah, let's share screen. So yeah, I mean the VIX, I'll just show you where the VIX curve is right now. It's looking quite funky right now. So, you know, a week ago, that was a flat to inverted curve with the short dates up here. Okay, so where's my little pencil? So the curve was something like this. So you had this October trading under September and August. Okay, so that's because the market went into full panic mode. So for me, the clear trade was to be selling September and buying October. Okay, because this steepness was going to come back at some point, because the October contains the election, which is easily worth a couple of vol points anyway in this thing, right? If this was a normal curve, the VIX curve would be looking something like that, basically, right? October would be trading here at like in the mid 17s or something, but instead it's trading much higher, and that premium there is all due to the election. Okay, so we were always going to get this hump return, and the closer we get to the election, the more that hump is going to be pronounced, basically, right? And the more uncertainty there is in the election, that might go even higher, because people might say, oh wow, the election, we might move 5% on the election. At the moment, the election implied move is somewhere in the ballpark of 3%, you know, and when that thing went inverted, it was essentially saying there is no election excess move, and now it's coming back, and it's coming back to about that sort of 3% level. So how did I play it? I didn't just go in with the suicidal sell futures in September and buy futures in October, because the truth is these things can invert massively, and you could see September go 5 points over if it wanted to, basically, right? So you could get hurt on that. So the way to do it was to buy September puts and sell October puts. We could do that at zero cost in certain strikes, whether it's 20 strikes, 18, 17, all those strikes, basically saying that the curve's going to fall back into contango if the vol goes back down below 20. Yeah. So that's what we were getting into. And those trades have been pretty spectacular. They've done a good job. They cost us zero premium. We did have to post some margin against them, but we've made ridiculous return on margin, right? Like, yeah, like we're talking 50% plus return on margin in a week. So it's pretty decent. Another way of playing this is to do like fly type structures. So in VIX, so if you don't want to go for the calendars and you don't have as strong a view in the contango or whatever, you just think vol's going to go back down, and you want to say, I want to give it till September. I don't know if vol's going to collapse by August expiry, even though it looks like it wants to. You know, if you think that you have more confidence that whatever turbulence there is on the geopolitics and on the macro, that by September VIX expiry, things kind of normalize, then some sort of long put fly kind of works. It doesn't look optically like it's giving you that great a risk reward in terms of what you spend and what you can make, right? But that's not the point. What you're trying to achieve with this stuff is you're trying to achieve a return on capital that is positive, that has a very high probability of success, right? So it's not like an option where I'll buy a 20 delta option, and let's say, like, I'm assuming that the delta is an accurate reflection of the probability of success, right? I'll buy a 20 delta option. Yeah, maybe I'll triple my money. But the probability of me tripling my money and making a 200% return is very low. So the expected value is actually not that big, right? Whereas if you are of the opinion, and it's a big if, but I am of that opinion, that the VIX gravity is going to kick in by September, and the chances are, you know, we are back to normal levels of VIX, which are kind of 15 and below. If that's your viewpoint, and that's a very high probability scenario for you, then you don't need a return on capital of 200%. You need maybe 50 to 100% return on capital on the trade, because it's got much higher probability of actually transpiring to have a good expected value, right? So that's the idea. So these type of structures, you know, like we're trading at like 17-ish now anyway, but a 17, 14, 13 put fly. And the reason why I've done 13 and done it as a lopsided put fly is to make sure that if vol just collapses, I'm going to make some money. I don't want a situation where my view is that the VIX gravity is just going to be there. We're going to go back down to really low levels of VIX. And then because I did a fly that was symmetrical, I just lost my premium and made no money. That'd be stupid, right? So that's why you do it in a way where, you know, if we go to the sweet spot, which I'm calling 14, then I'll make really good return on capital because I'll make 150, I'll make 100% return roughly. But if we keep going and we just collapse through the floor, at least I will capture some profit of around 30% return on capital, something like that, basically, right? So that's the idea. What you're trying to do is you're trying to say the probability that VIX closes below 7, or let's say what my break even is, right? Below 15 and a half. The probability it closes between 15 and a half is really high. And, it's going to give me positive return on premium if it goes there, basically, right? And if it doesn't go there, I can always stop out of this. It's not like I'm going to lose my full $1.50 on this trade tomorrow, right? I've got until September. So if we were to get another VIX spike that basically lost me, $75 on this thing, I can still cut it, right? So my entire risk doesn't have to be the $1.50 that I'm spending for this thing. It could be whatever I decide it to be. And basically that's like saying, I don't think VIX goes back above 20, but if it does, I'm using that as a signal to get out, basically, right? And then I'm risking 70 cents to potentially still make $1.50. And then the risk reward actually works better in your favor because you're running it with a bit of a stop. And the nice thing is this thing doesn't have bad time decay on it, really, right? So we bring up the table, it's got until middle of Sep, but you run this thing into the end of August and the vol stays here, you've got no time decay. And the same can't really be said for outright options, right? Outright options on VIX are trading on high vols. They're going to experience some time decay. Yeah. So that's what we're talking about. We're talking about using the expensive vol of vol. We're talking about setting up a positive expected value trade that optically might not look that great, but will work in that scenario where gravity just continues to take the VIX lower, and it will keep you protected because it's not going to blow you to smithereens if VIX goes through 20 again, basically.
That's an amazing explanation. Thank you very much. Can you just show the strikes again you traded or you have on the screen here?
Yeah, so I don't have this particular trade on. I've got an 18, 15, 14 September put fly on, which I put on a while ago for the same sort of price, $1.50. That's gone slightly in the money because obviously we've come down to 16 and a half here. So, if that goes to 15, that's my sweet spot for September. But then I've also got those VIX calendar trades where I'm long set puts and short October puts as well. But this particular trade is looking at is 17 put you buy, sell 2 of the 14s. This 17 put costs around 2 and a bit. The 14s get you back about 40 cents times 2. And then the 13s cost you like 15 cents just to cover that tail and make sure that you make some money if vol just falls through the floor. Now, if you are conviction bearish, if you are high conviction bearish on vol, this probably isn't the trade for you, right? In fact, maybe you just buy outright puts. If you say, I think VIX is going back to 12, then actually just buying this put for 40 cents is a winner, right? Because you buy the 14 put in September for 40 cents and it goes to $2. You just made 4 times your money, right? So that's another way of doing it. So it's really about where you think, how low can vol go? People are asking, where's the floor? If you think the floor's 15, then maybe you like the fly. If you think there is no floor and we could easily go back to 12, then just buy the outright puts because the vol of vol has come down a long way from those highs that it made. Yeah.
Yeah. Awesome explanation. Everyone's getting their money's worth, I think, on that one. So I think that wraps up for basic trade structures.